Hello and welcome. You're watching BloombergQuint. I'm Navneet Saluja D'Souza. Hexaware came out with its numbers post-market hours yesterday, and the numbers were largely in line. Let's decode the quarter gone by with the CEO of the company, Mr. R. Srikrishna. Hi, sir. Good morning, and thanks a lot for joining us. I think the numbers were largely in line what the street was factoring in. Though, however, on sequential basis, there was contraction seen in the EBIT margins. Could you take us through the quarter gone by and what led to this margin contraction?
So we have some margin contraction every year in Q4. It's a common enough pattern. If you go back and look at past many years, that happens. So we always guide our investors to look at our full year margins. What we said at the beginning of the year is that our margins growth will keep pace with revenue growth for the full year. And that's exactly what happened. We delivered 17.1% revenue growth and 17.1% EBITDA growth. So why is there always a little bit of contraction in Q4, and frankly that happens in Q1 as well, is there are some cyclical factors, and then this year there were some additional unique factors, right? So cyclical factors that happen every year, there is a downward calendar pressure, there's furloughs from clients. Additionally this year, we also have wage hikes, the full impact of wage hikes every year in Q4. Additionally, this year, the furloughs were actually quite a bit larger than normal. And we had a single client in BFS, one of our largest clients, which started having a downward impact, quite a steep downward impact in Q3. We guided for that to continue through Q4, and that happened through Q4 as well. So it's a combination of all these factors. The good news is, notwithstanding these additional factors that happened, sharper drop in that one client, much bigger furloughs, we still did what we expected to do because the rest of the businesses were actually doing very well.
Right. Mr. Srikrishna, you mentioned that one client which definitely impacted in Q3 as well. Maybe the repercussions of that were felt in Q4, but the entire downtrend due to that client has been factored in, or there could be more feelers that could come in the quarters to come?
Yeah. So, Q3, we felt it was not just repercussions in Q4. There was a continued decline in Q4. Much of it was anticipated, and so we had accounted for it for Q4, most of it at least. But the good news for us is, going forward, that's completely in our rearview mirror. So we've stabilized, it kind of came down, and it is now on a stable path. There will still be a little bit Q4 to Q1 impact because the full impact of the Q4 ramp down will only come in Q1. But on a monthly basis, our volumes are either stable or going up moderately. So, and we've certainly factored that into account for our full year guidance for 2020, which you may know is a very robust 15 to 17% growth.
Okay, I was just coming to that question on guidance for 2020. You've laid down revenue guidance of about 15 to 17%, EBITDA guidance of about 15 to 16%. Is it on a conservative basis, or it's more of realistic, or how do you see the trend panning out this financial year? How's the environment versus the year gone by? Do you expect that you can beat your guidance as well?
Well, we will certainly hope that we could, but it's too early in the year to say if we could or not, and that's why we provided a range of 15 to 17. It's a wide range, and if you could beat the top end, that'll be great. Is that a possibility? Yes. But there are risks, right? So I think kind of the biggest risks are macros. Coronavirus is rapidly emerging as a possible serious risk to everything, including our business. So there are certainly risks to us meeting these numbers.
Talk to us about the performance geographically as well as your different verticals. How did that pan out?
So from a vertical perspective, BFS was very sluggish, and that was entirely on account, or mostly on account, of this single large client. All of the verticals had amazing market-leading performance. So that very solid growth. We had like one vertical close to 30% growth, two verticals close to 20% growth. So they did very well. They may not keep that 30% type growth levels in 2020, but all of those verticals will do very well. BFS actually the underlying business will do quite well, but this client, while quarter on quarter we are stable, there is still overhang for the full year growth from last year. So that's going to impact BFS in terms of reported numbers, but the underlying business is doing very well. So that's vertical. Geographic wise, for us, Europe was the best performing in 2019. We actually expect that will continue through 2020, that we actually expect Europe to be the best performing of all of our geos.
So are you seeing any more orders coming in, especially from European banking space? And is there any pickup that you're witnessing for the capital market even in US?
Well, I think kind of there is going to be, there is a little bit of caution in capital markets that was there through last year. And I think that may continue through current year. And again, nobody's quite assessed the impact of what coronavirus could mean for all industries. But whatever I'm saying is outside that. So there is some sluggishness, but we've accounted for that in our overall guidance.
Have you guys directly being impacted, or do you see any sort of impact in the current quarter due to coronavirus?
Well, not necessarily in the current quarter, but there is travel industry everywhere has been impacted. Airlines volumes are down substantially. At least one of our airline clients is in serious distress. Others have canceled routes to China. Travel operators, the whole industry, the whole value chain is impacted one way or the other. And that, may have an impact on a business sometime down the line. There's also travel restrictions. Customers are kind of wary of traveling anywhere, certainly anywhere coming east. They're wary of our employees from east going to, Europe or the US. All of that, if it sustains and actually worsens, could have an impact on our business.
All right. Just one last question, Mr. Srikrishna, with regard to deal wins. What's the outlook for 2020 with regard to that?
Sure. I mean, so we take a look at two big buckets: existing customers, new clients. Existing clients, we've seen a systematic and continuous uptick in orders from existing clients over the past number of quarters. This is size of deals, quality of deals, breadth of services, all of it is improving. And we expect that momentum will continue for the foreseeable future. In terms of new customers, we made a shift in strategy through 2019 to focus on higher quality customers, higher quality revenues, through land and expand for digital deals in large customers. So that strategy is playing out. In addition, we completely reinvested in our US hunting team, and we think we have a world-class team now. So I think that is going to have a nice positive impact for us in 2020. We certainly expect 20 will be better than 19.
And what about acquisition? Any acquisitions are you looking at in the current year or going ahead? Any sort of cash that you sidelined for that?
It is highly unlikely we do anything in 2020. We just did a large one last year. We want to make it work really well, and for the first 6 months it has worked well, and we want to make sure that that continues and we realize full value from that before doing anything else.
I'm sure you've been asked this question before also, but do you plan, or is your largest investor planning to derive any synergies with regard to merger between Hexaware and NIT Tech?
Not at all.
All right, Mr. Srikrishna, we leave it on that note. Appreciate you joining us this morning, and all the best to you for 2020.